Hello folks, today we're going to cover lecture 16. In fact, this is the last lecture week or the last class week. So that's good news, right? So this is basically the last lecture for the class, and then the next week we are having the midterm 3 or the final exam, which will cover the chapters or lectures that we covered right after midterm 2. Lecture 16 is basically for this week. This is your last lecture. Of course, for the exam, I will send out a separate email when the exam will open and how long you will have to take it. I will also send out an email with the exam review. It will be a separate email, so wait for it. But for now, this is the video lecture for lecture 16, which basically talks about trade. We talked about trade, how trade benefits two countries or different countries, and it leads to specialization, and it ultimately increases the output for both the countries. So this is basically an extension of the trade. Basically it talks about the different trade agreements between the US and the other countries, how the different trade organizations evolved, and then it talks about the exchange rates, the currency exchange rates. So, and that will wrap up the microeconomics chapter, or the microeconomics course. Okay, so basically, just to give you a brief overview, the Smoot-Hawley Tariff Act was passed in 1930, and this increased tariffs in the US. So basically in the US they passed the Smoot-Hawley Tariff Act, and this increased tariff from 5% to 25%. So anyone who was trying to import goods, the prices went up by 20% because of this tariff. And this happened right after the depression or during the depression, because during the depression the government was trying to protect the local companies, the local businesses, so they did not face so in order to make sure they did not face severe competition from global markets, so that's why they increased the tariff, and to protect the small businesses within the economy, they increased this tariff. So in response to this tariff, there are 6 countries that retaliated, and this resulted in a fall of US trade by 25%. So overall it had a very negative impact, right? Overall, we know trade is good. It increases your output, your GDP, and because of tariff in the 1930s, the US trade decreased by 25%. Then another act came, which is called the Reciprocal Trade Agreement Act, and this was done in order to negotiate bilateral trade reductions in 1934. Basically, US government saw that US trade decreased by 25%, then they reduced the tariff for 32 nations from 25% to 5%. So not for everyone, just for 32 nations they decreased the tariffs from 25% to 5%, as a percentage of the merchandise imports. Okay, so during the depression and right after the depression, we saw the tariffs went up. This was done to protect the local businesses, but in the 1985 tariffs fell to very low percentage. That's basically it fell to 4%. And then in the 1990s, international trade expanded further. Negotiations between the nations and countries led to an all-time low of 1.3% tariff rate. So, in the 1990s, the tariff rate was only 1.3%, because that was the period when globalization started to boom. Everyone was involved in international trade that was helping each other's economy. So tariff wasn't seen as an important tool at that time. So the tariff rate decreased to 1.3%. Okay, so then right after the depression, again several institutions were established to facilitate economic growth and trade. So basically, in order to bring growth, in order to bring about trade after the depression, several institutions were created. The most successful institution was created by United Nations, and it was called the Nations Monetary and Financial Conventions through the Bretton Woods Agreement. Okay, so this was an agreement that was signed in order to avoid exchange rate disequilibrium. So any type of disequilibrium in the exchange rate was avoided under this agreement. Then it was also signed that reduced trade barriers. Trade barriers included tariffs, tax, embargoes. These were reduced, and then it also facilitated economic recovery. Another thing this agreement created is the IMF, International Monetary Fund Institution. I'm sure most of you heard about this. And basically, they control the exchange rates, and this was done in order to stabilize the exchange rate. When member nations maintain their currency value of exchange with a small percentage called a band, this nation could borrow from IMF for temporary stabilization. So the countries, if they maintain certain requirements and if they met certain conditions, they could borrow money from IMF for temporary stabilization. Currency rates were fixed to US dollar or with IMF. Okay, so the Bretton Woods Agreement also, it created the IMF, and it also created the International Bank for Reconstruction and Development, and also known as the World Bank. So we know it as the World Bank. So this is a very important agreement, right? This Bretton Woods Agreement created, it facilitated economic recovery, reduced trade barriers, smoothened the exchange rate system. It created the IMF. It created the World Bank, and it basically, the World Bank funds global economic development. Okay, it also proposed other organizations such as the International Trade Organization to reduce trade barriers and settle trade disputes, but that did not happen. But regardless, it did achieve a lot of things to bring about economic growth and as well as enhance trade between the nations. Then another thing that came was before we had GATT, and the GATT was reorganized in 1995 to form the WTO, or the World Trade Organization. Again, I'm sure you heard about this entity, and basically previously it was known as GATT or GATT, and in 1995 it was reorganized to form the WTO, or World Trade Organization. So its goal was to facilitate free trade without any negative side effects to all the parties. Okay, and this World Trade Organization stated that people or the countries should engage in trade. Let's say US should engage in trade with Canada, Mexico, without discrimination. So a country should not discriminate between its trading partners, and it should not discriminate between its own and foreign products or services. So basically, US should treat Canada as the same way as US should treat Mexico. That's what it's trying to say. There shouldn't be any type of discrimination between the trading partners. Then more free, basically it's saying the tariffs, the trade barriers, the regulations need to come down so that there's more trade between the countries, and there's more negotiations. It also stated that the trading system should be predictable. Every party should be confident that trade barriers should not be raised arbitrarily and are bound by WTO rules. So the government will not come and suddenly increase tariffs for no reason unless they are bound by the WTO rules. Okay, so that's predictable. Then the trading system should be more competitive. Basically, it will discourage unfair practices, and local market will be competing with international markets, so it will be more competitive. And unfair practices such as export subsidies and dumping should not be considered, or should not be implemented in the countries. Finally, it should be more beneficial for less developed countries, giving these nations more time to adjust and special privileges. The developed countries are probably already doing well, like US, Canada, but less developing countries, such as Bangladesh, Myanmar, they need more time to adjust to the system. So what the WTO suggests that we should the trade should be more beneficial, and nations should give more time for less developing nations so that they can adjust to these special privileges. This organization basically said equal treatment of nations, tariffs and other trade restrictions must be equal. So if I have 5% tariff rate on Mexico, I should have 5% tariff rate on Canada and the rest of the world. That's what it's basically saying, no discrimination. This also offers settlement of disputes. Basically, if there was a trade war between two countries, they could come to a settlement. It allows the nations to file an appeal and explain their complaint, and then both the parties can negotiate and solve the problem. WTO basically negotiated several trade agreements, such as the Tokyo round, the Uruguay round, the Bali round, the Nairobi conference. These are some of the trade agreements negotiated and completed by the World Trade Organizations, and they have been very successful. Imports and exports take place through the exchanging one currency for another, because different countries have different currencies. So when imports and exports takes place, there is exchange for currency as well. So that's why exchange rate is also very important when we are considering trade. So currency value is determined. So whether US dollar, what is the value, or Canadian dollar, what is the value, is determined either through the flexible exchange rate system or the fixed exchange rate system. So there, as far as currency is concerned, there are two types of exchange rate system: flexible and fixed. So the US has a flexible exchange rate system where the value of dollar is determined through the forces of supply and demand in the international market. So it changes every day. Flexible interest rate is, it will change every minute, it will change every day, and it depends on the supply and demand of the international market. Whereas fixed exchange rate is basically when the value of the currency is fixed, or it is determined by the government relative to another currency. So let's say China has a fixed exchange rate and it is fixed relative to US dollars. So the government is saying there is a fixed exchange rate. Okay, so that's fixed exchange rate. Basically, let's say if the $1 is going to be, let's say, 30 yen, and that's fixed, it's not changing. Whereas under the flexible exchange currency system, $1 will be equal to 20 pesos today, and tomorrow it can be 30 pesos. So it depends on the forces of supply and demand. Okay, so currency is very important when we are considering trade. Okay, now the demand for American produced goods and services will create demand for US dollars, right? Basically, when foreigners are trying to buy American goods, they will need US dollars to buy those American goods, right? Same way, American imports create the supply of dollars, okay? So exports create demand, imports create supply. So if Japan, the example I'm trying to give is, let's say if Japan wants to buy American beef, they must exchange the Japanese yen for American dollar to make payment. While if American firm is trying to buy Japanese cars from Japan, they must exchange the dollar for yen to make the payment. So these payments are measured within the balance of payment statement. So balance of payment statement is basically a type of financial statement that is maintained by the government that records all these exports, imports of goods and services, the net investment, as well as capital investments. Okay, so here if you see on the slide, the first line, the balance of payment statement is maintained by the government, and it is a summary of all economic transactions of a country, much like a national income statement. Okay, so maybe, like, you heard about profit and loss statement or income statement in any accounting class for a company. So a country can have a similar type of national income statement, and that is basically called the balance of payment that accounts for global transactions. I wanted to give you an example of how balance of payment looks like for a country, and I will do an example for US so you have an idea of how it looks like. Okay, so all right, so let's say this is the US balance of payment as of 2014. Okay. Ooh, that's very thick. All right, so first account we have is called the current account. Okay, and this is something, it's just for your idea. You might have to, I will not ask you to prepare one, but you have to know what are the accounts and what are the different items listed in this. Okay, so under the current account we will have US good exports. Good, like table, chairs, laptops, computers, beds, these are all US goods. Okay, so US goods exports, and it's a positive number because foreigners are buying from us. And then we also record US good imports. This is goods we are buying from foreign countries, and this is going to be a negative number because this is outflow of income to foreign countries. Okay, so in this case the balance of good for good, this is for good, so the balance of good is basically we do 1635 minus 2371. I'm sorry, this is 2371, and this is equivalent to minus 736. Okay, so same way Under the current account, we will have the services. So US exports services, and let's say the number is 710, and then US, let's say, imports services, and let's say it's going to be a negative number because we are importing, and let's say it's 479. So the balance on services is 231. Okay, so finally the balance on goods and services is, we add those two numbers, so we will do 231 plus minus 736, right? That's what we got from the good. You scroll up, you will see, oops, not this. Here we had 736, so minus 736 plus 231, that is the balance of goods and services. So we have here a negative 505. Okay, then other accounts that are recorded under this are net investments made in the US in 2014. That was, let's say, 450 billion. Okay, and that's a positive number because the money is coming to the US. Then net transfer, that's money going out of the US for investments, let's say, is minus 58. Okay, so now we have the balance on investment and income is, we do 450 minus 58, which is minus 113. Okay, and finally the last account that is listed in this balance of payment statement is basically capital and financial account. Under this we have, capital, oops, I'm sorry, under this we will have capital finance account, that's 77, and then we have estimated, let's say, errors. There will be some errors in calculating the trade, right? So estimated error is, let's say, 36. So if we add minus 113 plus this, we end up with 0. So at the end of the year, the balance of payment account should be 0. So remember this thing. The goal is to have the balance of payment account at the end of the year to be 0. Okay, that's how we are doing with the capital financial account, with errors and omissions, net investment, and current accounts using the exports and imports of goods and services. We should have a balance of payment that gives us 0 at the end of the year. So hopefully that gives you an idea about the balance of payment statement, how it looks like and how it is maintained by the government, and it must always balance at the end of the year. It must always balance. Okay, so Americans buy more goods and services, then they sell and give more gifts. Net investment inflow is not sufficient to cover other current account outflows. The payment balance is secured from purchases of the US assets such as treasury bills, bonds, and notes, as well as sale of American businesses and lands. That's how they will balance. It's otherwise it won't balance. Okay. Then each trading nation's currency is valued by the supply and demand of their currency. We discussed this before. For instance, if US is importing more goods and services from Canada, this difference in balance must be paid by US dollar outflow. With an increase in import from Canada, the demand for Canadian dollar will increase, right? So we are buying more goods from Canada, which means the demand for Canadian dollar has gone up, so the value of Canadian dollar will go up and the supply of American dollars will go up. Okay, because we now need, probably if the value of Canadian dollar goes up, previously probably one Canadian dollar was, let's say, 10 US dollars, but because the value has gone up, now one Canadian dollar is equals to 20 US dollars. So we need more supply of dollars. So when the supply of US dollar increases, the value of US dollars will fall. So let me show that in terms of a graph. Okay, let's say this is for Canada and this is for US, and this is, we are talking about exchange rates. Okay, now we know this is the demand and this is the supply. Okay, demand, supply. Now let's say Americans import more goods from Canada, so there is more demand for Canadian dollars, so the demand for Canadian dollars go up, the demand curve shifts to the right. What happens to the price? You see the price has gone up, which means the value of Canadian dollar has gone up. When we are trying to import from Canada, the value of Canadian dollar will go up because of an increase in demand. On the other hand, right now we need more US dollars to buy goods and services because the price of Canadian dollar has gone up. So that means the supply of US will go up and the supply curve will shift to the right, causing the value, if you see, to go down further. Okay, so hopefully that explains how imports or exports can impact the value of the dollars, and thereby your, basically how other nations currency appreciates and our nation's country depreciates, or vice versa. Okay, so I want to talk a little bit about fixed exchange rate. So some nations use this fixed exchange rate system, such as the China, basically to control the value of their currency at a constant rate of exchange among currency. So the nations make their internal adjustments to keep the currency in equilibrium. Whatever little adjustments are needed to make to keep it at the fixed rate, they will do it. But it is basically fixed at it is fixed relative to a currency. So let's say one US dollar will be equals to 100 yen, but one Canadian dollar will be equals to 90 yen. So it will vary from country to country, or basically the amount is fixed relative to the another currency. Okay, but in the case if there is a major disequilibrium in trade or major disequilibrium in the exchange rate, the nation is either forced to change currency value or adjust their economy relative to trade. So they will either be forced to change the currency value because they are keeping it fixed and it does not automatically adjust with the market as a flexible interest rate, as a flexible exchange rate system, and they can also adjust the economy relative to trade. They can lower the amount of trade or they can increase the amount of trade to affect the currency value. So they can change value by devaluing their currency or decreasing the value compared to other currencies gold, or revaluing the currency or increasing the value compared to other currencies. Basically, they can increase their currency value or increase the or decrease their currency value. Both systems work well as long as a nation's balance of payment remains substantially in balance. So basically, the ultimate goal is to keep the balance of payment to balance at the end of the year. It does not matter whether you use fixed exchange rate system or flexible exchange rate system. Both systems have goods and bads, but at the end the balance of payment needs to balance, and that's what is the main objective. Now, advantages of fixed and flexible exchange rate systems. So fixed exchange rate systems provide greater stability because we know that it's not changing, it's going to be fixed. So we know what is the rate, so it provides greater stability, and there is more certainty of currency value for business contracts, right? So after 2-3 years, the value will not change a lot. Let's say I do a contract with a China firm to build a hotel in China, and now one US dollar is 100 yen, but after, let's say, 2 years, when I will be done building the hotel, one US dollar can be 150 yen. So um, that that this uncertainty is not there under a fixed exchange rate system. Also, the value of the currency can be influenced by a government in payment deficits. Central banks can use past currency official reserves if they are available. So if there is any type of imbalance, government can play a role. Advantages of flexible exchange rate: it basically allows automatic adjustment of exchange and on a real-time basis. It's changing every minute, every day. This system makes contract costs scheduled for delivery in the distant future less certain. That's a disadvantage. However, actual costs can increase or decrease by differences in exchange rate. So that's a disadvantage of flexible exchange rate. So under a flexible exchange rate system, there are many determinants. Okay, so the determinants of flexible exchange rate system are: number one is the real interest rate. Real interest rate is, if real interest rate is higher in the US than Canada, then all other things remaining the same, the value of US currency will increase. So I guess you understand what I'm trying to say from here. Basically, if US interest rate is higher than the Canada's, then the value of US will increase. Basically, US dollars value will go up and Canadian dollar will go down. More investors, this is because more investors will be encouraged to make investments and obtain greater return. So the demand for currency will go up, and as a result the value will go up. Another thing that determines the flexible exchange rate is the relative income of nations or of countries that impact the value. So, countries with higher national income will have a higher demand for imports, and thus increase in the supply of currency, causing the currency value to depreciate. On the other hand, nations with relatively slow growth, those countries that have stagnant growth, they'll probably have low imports and they will have higher demand for exports. As a result, the currency value will appreciate. So like the US, it's a fast growing country, there's a lot of imports there, so as a result the value of dollar depreciates because of that. So real interest rate, relative income of countries, these are two factors that impact flexible exchange rate system. Another thing that impacts it is the relative inflation rate between the countries. So a nation with higher inflation rate will buy more imports and sell fewer exports, thus causing the currency to depreciate. And a country with lower inflation rate will basically buy less imports and do more exports, so the value of currency will appreciate. So inflation rate is also important in affecting flexible exchange rate system. Speculators can also cause changes in the price of currency when they trade in turbulent markets. They are speculators, they are trying to increase the supply of the currency or decrease the supply of the currency. They buy or sell currency and cause temporary changes or temporary adjustments in the market. Okay. Finally, central banks sometimes use managed float to intervene directly into the global currency market to stabilize their markets. So central banks can also play an important role. Again, these are factors that will affect the flexible exchange rate system because this is always changing. It's on a real-time basis. So factors, you need to know the factors that will affect the flexible exchange rate. That is the real interest rate, then the relative income of countries, then the relative inflation rate between countries, speculators, and the central bank. For a fixed exchange rate, these factors are not affected because the rate is fixed by the government and the central bank. Now, countries can have negative current account balance. That can be a good thing or a bad thing, but in the long term, the balance of payments should always balance. But when a country has a negative current account, what it means is basically the country is experiencing higher growth, high relative growth compared to other countries. Thereby, their imports are more than their exports. Also, it also means probably there is a decrease in trade barriers, so there's more imports. Lastly, there is a large inflow in the capital account, allowing Americans to reduce savings and buy more imports. So these are factors that can cause the current account in the balance of payment to be negative. So negative current account, the last slide basically says, is not a good thing. Actually, in the short run it may make sense, but in the long run it is not good, so like in the US right now we have a negative current account. In the short run it probably makes sense because the US continues to consume more than it produces, and the American current standard of living is benefited. Okay, but in the long run, if this continues for a long period of time, this deficit continues, then there will be a loss of confidence in American investments. And what will happen? Global funds will be withdrawn from our investment market, and this will cause the dollar value to fall. So that's why negative current account is not good for a long period of time. So make sure you understand, even though we can have negative current accounts in the short run, in the long run we don't want the current account to be negative for a long period of time, because it's going to reduce the value of the dollar through reduction in global investments. Okay, however, it's not an immediate problem right now for the US, although it's a negative right now, but it's not an immediate problem. So that's the end of lecture 16 and the end of this class. Hope I had a great time teaching you guys. I wish you guys all very good luck for this semester and for your future. You will get a separate email with instructions about your exam, which is next week, and you will also have an exam review that I will send out in an email for you to prepare. Okay, but other than that, if you have any questions, if you have any concerns, you can email me. I know we had to shift to an online medium because of the coronavirus, and probably it got very difficult for some of you, but again, I'm here to help you. Any questions, concerns, email me. I'll try to help you. Until then, you guys stay safe, and wish you guys all the best. Thank you.